Hi guys. Today we will analyze Dell Technologies stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. In the past year, Dell was a good performer in the market. The short-term trend is neutral. The long-term trend picture is still unclear. We need to see a little more continued positive action to open a long position. Strong support levels are around $48 and $46.20. The next strong support level is around $39. Resistance level is around $55. The next resistance level is around $60.50. In the last month the stock has been trading between $49 and $55.30 range. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 4.3 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 11% per year, for last 5 years. We see that the average profit margin of the stock has been around 3% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Dell Company: bad, average, and good. First scenario. Dell will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 3%. Future profit margin would be low, 3%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $61. Second scenario. Dell will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 4%. Future profit margin would be average, 4%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $92. Third scenario. Dell will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 5%. Future profit margin would be high, 5%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $130. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 7.02. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Dell, analysts forecast growth rate around 4% per year in next 5 years, and future P/E around 8. Again, I will use 3 different scenarios for Dell Company: bad, average, and good. First scenario. Dell will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 3%. Future P/E would be low, 10. In this case, the fair value of the stock today would be $33. Second scenario. Dell will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future P/E would be average, 11. In this case, the fair value of the stock today would be $40. Third scenario. Dell will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 5%. Future PE would be high, 12. In this case, the fair value of the stock today would be $47. As you can see, today the stock is a little bit overvalued, $55, even if we expect the company's high performance in future. There are some concerns on Dell's financial health, and the company is expected to show a very small growth in revenue, 4% yearly over the next 5 years, but the stock looks fairly valued. The stock's current low valuation adequately reflects the company's near-term challenges. It's a good buy, if you believe that Dell can manage its debt. Company's strengths. Dell Technologies is an American multinational technology company. Dell operates two businesses: Infrastructure Solutions Group, which provides enterprise server, storage, and network solutions, and Client Solutions Group, which provides personal computers and peripherals. In November 2021, Dell spun off VMware. Dell made substantial progress in strengthening its balance sheet in FY22, reducing debt by more than $16 billion. In addition, it approved a $5 billion share repurchase program in late 2021, and is initiating a quarterly dividend of 33 cents per share. Annual growth was driven by high-end consumer, gaming, and storage and peripherals demand. While notebooks continue to drive commercial revenue, desktop orders are recovering. The reopening of businesses and offices is driving demand for high-end commercial machines. Dell is also positioned to leverage accompanying trends, including AI data center, enterprise mobility, Internet of Things, and everything as a service. From a valuation perspective, Dell is inexpensive by historical standards and relative to peers. Dell's return on equity of 76% is amongst the best returns of the industry. Dell has a return on assets of 8%. This is better than the industry average of 6%. Risks. Dell's overall production continues to be gated by industry-wide supply chain challenges. Dell faces risks from operating as a do-it-all IT company, a model that has grown unpopular on Wall Street, and in the technology world. Companies such as HP have chosen to split in two, while IBM has divested all non-enterprise, low-margin commodity businesses. The disposition of VMware should reduce organizational complexity. The company faces risks if vaccines allow a return to more normal work patterns, potentially leading to excess capacity, and making Dell overstaffed for its available markets. Dell is not financially healthy enough and could expect problems in meeting its short-term obligations. Dell has negative shareholder equity, which is a more serious situation than a high debt level. Dell is new to the dividend game, and has less than 3 years of track record. Dell lost a high-margin asset in VMware, which typically accounted for 1/3 of operating income. Dell is expected to show a very small growth in revenue and earnings per share. In the coming 5 years, the revenue will grow only by 4% yearly, the EPS will grow by 1% yearly. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.